Hi everyone, it is Monday the 10th of October and that means it's time to take a look at what moved the markets last week. Starting with the same old, we can see the NSDQ100 and the SP500 followed much of the same pattern. That being a very strong bounce off of the oversold conditions that we saw towards the end of September, followed by a dip almost to exactly where they started the week. We can also see, unsurprisingly, that the 10-year yield on, this is US bonds, had experienced the opposite type of price action, and that's because there's typically an inverse relationship between equities, risk assets, and the bond yields. We can also see on the bottom right that dollar strength persists, and similarly to bond yields, it followed the inverse pattern to US equities. What's quite interesting, especially in the wake of what happened in the UK 2 weeks ago, is that the same pattern played out more or less in UK equities, but the selling wasn't nearly as strong as it was in US equities, and UK stocks did pretty well towards the end of last week. Now, what was the reason for all of this turmoil? Well, just before I start, by the way, you can see that China was closed for all of last week, so there wasn't much going on there, although that seems to have changed this morning. So what caused the price action in equities and other assets last week? Well, we can see that on Tuesday, we got this jobs opening data out of the US, and the number came in significantly lower than what was forecast, and because there were significantly fewer job openings than were anticipated, that meant that the market started to celebrate. It was throwing a little party. The reason for this little party is that everyone in the market now knows that the Fed is looking at two major areas of data in making its decision about forward-looking policy. Those two pieces of data are the jobs data coming out of the US economy, as well as inflation data. So PCE is the measure that the Fed looks at when trying to make decisions based on inflation. Now, what the Fed wants to see is inflation coming down sharply and staying low, and it wants to see jobs data showing weakness. It wants to see a higher level of unemployment. It's hoping that by having more people unemployed in the economy, that'll bring down wages, and wage inflation tends to be a sticky kind of inflation. So these two pieces of data are now the most important thing, and the market knows that. So when the market saw this enormous drop in job openings, it thought, hey, we're one step closer to that Fed pivot. Unfortunately, a little bit later in the week, so on Friday, we got the NFPs, non-farm payrolls, which came in higher than expected. So more people on payrolls, non-farm payrolls, than expected, and the unemployment rate came in at 3.5, quite a lot lower than what was expected. These two data points caused the market to reverse because the assumption that the market had made based on the data earlier in the week had been undone. Now, what's important to note is that you can see the job openings number is definitely coming down. The non-farm payroll numbers seem to be coming down, and unemployment seems to have plateaued around the 3.5% point. Just so you know, the Fed is looking for this number to be around 4% instead of at the current levels. Now, given the price weaknesses that we're seeing in the US and also other economies around the world, it does seem as though these prices will come down. There's a global slowdown going on. Many companies have stopped hiring additional employees. Some of them are laying them off in very high volumes. It's just taken a while for the Fed's policy to filter through to this area of the economy. It is one of the last dominoes to fall, and fall it will. The Fed has been very aggressive. So it's just a matter of time before we see more weakness in the jobs data. In terms of inflation, that's the other piece of data we can see in this silly picture. It's an accurate picture despite its silliness. And we can see that, unfortunately, the recent readings have kept it more or less at the level that it has been at for the past few months, but it does look as though the peak is behind us. Now, as I've mentioned in past videos, for the past few weeks and months, the reason that the market is looking so closely at this data is because it is hoping that the Fed is not going to be hiking as aggressively as it has been recently, going forward into the next year, 2 years, etc. So when it seemed that there was weakness in the jobs market early last week, the stock market starts to reprice equities based on the Fed pivot being earlier than is currently priced in. And then later on, when we got the contradictory data on Friday, the market attempts to reprice equities in the other direction. The Fed is going to stay on plan, maybe keep rates higher for longer. So while the sell-off on Friday was painful, it does look as though the worst of this data is behind us. The Fed is getting what it wants. It's just taking a little bit longer to arrive than the Fed would like. What I found quite interesting is that this report from the IMF is now saying that one of the biggest potential economic risks has been contained, and that's the wage price spiral risk. So there was a chance in the recent past that we would fall into this trap. If the price of things are rising, workers will demand higher wages. Because their wages are higher, the people that employ them put up the prices of the things they sell. Because they're putting up the prices of the things they sell, workers push for higher wages. And this creates this spiral where prices just keep on going higher and higher and higher, and quite easily can lead to stagflation. The IMF is now saying this was a risk to the global economy, but it looks as though the actions of central banks have taken care of it. There's still a bit of pain to be worked through, but at least this is one less thing that we need to be worried about. So that was the big thing that moved the markets very dramatically last week. We are also at the very beginning of earnings season. Micron posted their earnings not so long ago, and they were fairly weak. That was anticipated, and actually the stock went up, even though the numbers that they posted in their earnings report weren't so great. Another of my companies in the UK reported earnings. So this is a company that I've held for a long time, and I hold in Etoro and outside of Etoro. And this is JD Wetherspoon. This is a franchise, a chain of pubs within the UK. This type of business has had a very tough time in the UK, but also elsewhere. Hospitality has had a tough time overall. And there's seemingly a bit more pain in store for hospitality businesses, especially because coronavirus seems to be on the increase again, but also the cost of living crisis in the UK, high inflation, means that people are less likely to go out to eat out. I like JD Wetherspoon for a few reasons. The owner is one reason not to like it. I think that he's a very horrible man, but it is a very successful company. They employ a lot of people within the economy, and as you can see, this is the financial performance of the company, or summary of that, from the founding of the business all the way through to this year, the financial year that they've just reported on. And you can see that the first time that they reported a loss in this entire history was because of the pandemic. I have been a little bit worried about my holding in this business given the cost of living crisis and the situation that I described earlier on, but the company's done a lot of very clever things through the past year to make sure that they have enough money to run the business, but also to control their costs. I invite you to read even just the first page of the earnings report. They're not called earnings reports, by the way, in the UK, but they're always quite entertaining reads. They're fairly informal. And there was a lot of reason for optimism in this trading update. So for example, they're only now 4.7% off of their pre-pandemic revenue. And in fact, their revenue position improved through the year. So you can see by the fourth quarter, they were less than 1% off of their revenue in the same quarter in financial year 2019. So the revenue situation looks quite good, and I think it's going to continue to improve through the coming year. But what about profitability? Well, profitability is only going to return to something approaching normal levels next year, and that's for a few reasons. First of all, costs have increased, but also they delayed a number of improvements and maintenance on their portfolio of properties. They own hundreds of pubs outright, and they delayed the maintenance of this until this year, but their balance sheet is still remarkably strong. The company did issue more shares. I think there were 2 rounds of issues in order to raise additional money, so there's a dilution for shareholders of about 20% that's happened through the past 2.5 years or so. But some of the other very clever things they've done is they've managed to fix the cost of any debt that they need to draw down on through to, I think, 2031. They also managed to lock in the energy prices and some of their supplier prices way before prices started jumping. And that means that they are able to keep their costs lower than inflation despite the increase in costs elsewhere in their business. So for example, in the wages for those that they employ. The company has also offloaded some of the properties that they own, and they do this from time to time. It helps them raise funds, but also when they find that certain establishments are performing poorly, maybe because of the location, they shut those down, get the money, and redistribute it elsewhere within the business. So JD Wetherspoon is a hold for me. I think that their profit next year is likely to come in roughly within the £50 million range, and that's not reflected yet in the share price that we see today. The share price is down to about £5, so this is GBX, so those are pence, down from a high of £17, so quite a strong drop. But I expect they will find themselves within the 12.50 range GBX within the next, let's say, 12 to 24 months. So I will continue to hold there. Despite the Chinese market being closed for business last week, there is still quite a lot going on. So we will see the 20th Party Congress, I think it kicks off on Sunday of this week, the 16th of October. This is an incredibly important event. It happens every 5 years. Within China, we sometimes get to see some major changes in the political party, the political ruling party within China, but there are also going to be other little tidbits, hopefully, that mean that we should follow the event quite closely. So, for example, is there going to be a change around the COVID-0 policy? God, I hope so. We'll get more detail around their approach to China's economy through the next 5 years, 5 or 10 years. Will China become more aggressive towards Taiwan, etc., etc.? It'll be a very, very interesting event to watch, and we should follow it closely. What about in the coming week? Well, as usual, there'll be lots of bits and pieces of interesting data. So GDP data out of the UK being one that I'll be following quite closely, but the macro data that the market will be laser focused on has to be the CPI data out of the US on Thursday of this week. You can see the expectations here in the middle column. I am a little bit concerned because the PCE data, the inflation measure that the Fed uses, came in slightly higher than expected last week, but we will see what happens. On top of that, we also are at the beginning of earnings season, as I mentioned, in the UK, but also in the US, and we will start to see some very large companies reporting through this week. Earnings are always followed closely, but I think that they are probably more important this quarter than they have been in a very, very long time. The market is pricing in a global slowdown, a slowdown in the US, a slowdown in the EU. The question is, how deep does that slowdown go? Well, as companies start reporting earnings, they'll present us with the facts and figures around what has happened already in the past quarter, but we should also start seeing some forecasts. If companies start materially downgrading their earnings forecasts, and no companies are perfect, some of them will be very pessimistic and some of them will be very optimistic, but hopefully in aggregate we get a decent picture. And if in aggregate earnings look like they're going to drop by more than analysts had been anticipating, I think that we will see a repricing across the board for risk assets. All right, that's it for this week. I hope you found that useful, and I'll speak to you soon. Goodbye.